the Nobel Prize winning economist, which is me. The fund was formed in 1993 and was founded by the renowned Solomon brothers, John and Mary.
Oh, there is an investor! Hey! Come here!
The party don't start till I walk in. Don't stop, make it pop. DJ blow my speakers up tonight. I'ma fight till we see the sun.
I'm a billionaire and I want 50% return. Do you think
It's okay, just trust us. We are Nobel Prize winning economists and traders.
where do you come in? I will double my money if you guys can make high return.
Sure.
I'll leave my money.
So what should we do with this lump sum money?
We put the majority of money for security in multiple
Cool.
LTCM was a very large hedge fund with $126 billion in assets, which nearly collapsed in the late 1998s. The founder, Solomon Brothers trader, John Meriwether, and the principal shareholders were Nobel Prize-winning economists Myron Scholes and Robert Merton. They were all experts in investing in derivatives to make high returns that outperform the market. The model formula that Scholes and Merton invented is credited as the basis for most risk calculations, even today. Therefore, LTCM was based on experimenting in mathematical risk management. According to the basic principle, the price of a security would converge to its fair market value even though it may be mispriced in the short term. So LTCM utilized computer models to find arbitrage opportunities between markets. The central strategy was convergence trades where securities were incorrectly priced relative to one another. Hence, LTCM would take a long position on underpriced securities and short position on overpriced securities. LTCM had employed 5 trading strategies which are convergence trades, outright equity purchases, fixed income arbitrage, volatility trade and relative value trade. The relative value trade can be subdivided into paired trades, swaps, pooled mortgage market investments, and yield curve trades. However, the 2 main trading methods that LTCM used were fixed income arbitrage and volatility trading. For fixed income arbitrage, the strategy is based on betting that the spreads between various types of related instruments would return to normal historical relationships. LTCM would buy the underpriced instrument and sell the overpriced one. For volatility trading, LTCM buy the underpriced securities when the implied volatility is lower than expected and sell the ones that have higher volatility than expected. The expected volatility is computed from the Black-Scholes option pricing. Generally, the difference in values is usually small, so the fund needs to take large and highly leveraged position in order to make significant profit. This is an example for fixed income trading strategy. If bonds in Russia offer very high yield or low price bonds, while bonds in United States offer very low yield or high price bonds, LTCM would long Russian bond and short US bond, hoping that the spreads between the 2 yields would decrease and they will make a gain because in that case Russian bonds will be relatively expensive while US bonds will be cheaper. However, in reality, bond prices move on the same direction, leaving small profits for LTCM. But because of the highly leveraged position, it can make a considerable amount of return.
Marks the anniversary of the day 1998 when Russia shocked the world by defaulting on its debt. But the ruble's devaluation set the stage for a decade of fast economic growth. This time around, though, economists forecast a slow recovery. Zinaida Medvedeva compares the 2 crises.
The crisis of 1998 was homegrown with a large government deficit financed by short-term loans. 10 years later, Russia became a part of a global financial crisis, with slumping oil price and high corporate debt sinking Russia's economy. After years of high oil prices, the government had accumulated reserves and a welfare fund worth more than $600 billion. That left enough money to recapitalize the big banks, bail out the biggest companies, and support the currency.
I think Russia learned its main lesson from 1998. namely that it preserved a significant part of its oil wealth that it's now using to combat the crisis. But as it turns out, it probably is not enough to deal expeditiously, swiftly with this crisis. And more needs to be done, more restructuring at the micro level.
A decade ago, the ruble lost 2/3 of its value overnight. But that allowed Russia's economy to resume growth within 3 months. Both the crisis and the recovery are already lasting much longer this time. Claims made in the summer of 2008 that Russia was a safe haven were clearly incorrect. The long time it took to recognize the depth of the crisis may cost Russia's economy, but no one can say how much. Political slogans that Russia could emerge stronger from the crisis don't convince economists.
This crisis did not require Russian business to pay full price for its mistakes. We can see often cases when banks are not able to get back their credits, when companies say that, okay, it's not good time to repay debts, and that means that there is no basis market discipline.
Russia continues to see dire economic statistics. Some experts suggest the economy has reached bottom, but even fewer dare to forecast recovery.
Almost everyone agrees that systemic changes and diversifying away from an oil-based economy is essential. But with the price of oil around $70 a barrel, which is $15 more than required for a balanced budget, there may not be the political will. Zinaida Medvedeva, Business, RT.
The Russia crisis in 1998 was the main cause of failure of LTCM. In August of 1998, Russian stocks, bonds, and currency markets weakened due to investors' fear of Russia not being able to make the repayment back to foreign creditors. As a result, Russian stocks, bonds, and currency markets weakened. It defaulted on its own debt and announced the devaluation in the ruble. Because of LTCM's spectacular annual returns of 42.8% in 1995 and 40.8% in 1996, it attracted many large financial institutions like Bear Stearns to invest with them. Therefore, when Russia declared it was devaluing its currency and defaulting on its bonds, this event was beyond the regular circumstances that LTCM had predicted. The U.S. stock market dropped 20%, while European markets fell 35%. This event created a flight to quality. Investors sought refuge in the U.S. Treasury bonds, causing long-term interest rates to drop by more than a full point. Moreover, when the markets went haywire during the summer of 1997 and into 1998, LTCM responded to the new opportunities by substantially increasing its volatility trades. This made LTCM's position highly leveraged. The trade ate up the cash that the company might have used to ride out other positions. As a result, it lost $1.3 billion just on the volatility trade. By the time the hedge fund had nearly gone bankrupt, it held nearly $1.25 trillion worth of over-the-counter derivatives, and only $4 billion. When looking at the leverage factor, LTCM had a debt-to-equity of 30-to-1 in capital, which posed them to be in a highly leveraged position. The government believed that LTCM was too big to fail. If let it collapse, it would cause a huge impact to the overall economic situation. So the Federal Reserve intervened by injecting $3.5 billion into the fund and took over their management in exchange for 90% of its equity.
Period. The whole long-term capital management, and I hope most of you are familiar with it, but the whole story is really fascinating, because if you take John Merriweather and Eric Rosenfeld, Larry Hillenbrand, Greg Hawkins, Victor Agani, the two Nobel Prize winners, Merton and Scholes, if you take the 16 of them, they probably have as high an average IQ as any 16 people working together in one business in the country, including at Microsoft or wherever you want to name. So an incredible amount of intellect in that room. Now you combine that with the fact that those 16 had extensive experience in the field they were operating. I mean, this was not a bunch of guys who had made their money, selling men's clothing and then all of a sudden went into the securities business or anything. They'd had in aggregate, the 16 had probably had 350 or 400 years of experience doing exactly what they were doing. And then you throw in the third factor, that most of them had virtually all of their very substantial net worths in the business. So they had their own money up, hundreds and hundreds of millions of dollars of their own money up, super high intellect, working in a field they knew, and essentially they went broke. And that to me is absolutely fascinating. I mean, if I ever write a book, it's going to be called Why Smart People Do Dumb Things. My partner says it should be autobiographical, but but this might be an interesting illustration. And these are perfectly decent guys. I respect them, and they helped me out when I had problems at Solomon, and so they're not bad people at all. But to make money they didn't have and didn't need, they risked what they did have and did need. And that's foolish. That is just plain foolish. It doesn't make any difference what your IQ is. If you risk something that is important to you for something that is unimportant to you, it just does not make any sense. I don't care whether the odds are 100 to 1 that you succeed or 1,000 to 1 that you succeed. If you hand me a gun with 1,000 chambers, 1,000,000 chambers in it, and there's a bullet in one chamber, and you said, put it up your temple, how much do you want to be paid to pull it once? I'm not going to pull it. You can name any sum you want, but it doesn't do anything for me on the upside, and I think the downside's fairly clear. So I'm not interested in that kind of a game, and yet people do it financially and without thinking about it very much. There was a great book. It wasn't a great book. It was a great title. There was a lousy book written once with a great title by Walter Gutman. The title was You Only Have to Get Rich Once. Now, that seems pretty fundamental, doesn't it?
Big lesson learned from the collapse of LTCM is that the risk models may not be accurate in reality. You should not base your decision entirely on the risk models. Instead, you should take other important factors such as economic risks, political risks, market risks, and etc. into consideration when making investments. Here are the recommendations to avoid this situation to occur again in the future. First, increase transparency. LTCM's trading strategy was secretive, promising only a big return to investors without disclosing how the money was used. Proper disclosure documents and transparency should be disclosed to investors concerning its position, exposure and trading strategy. Second, model risk should be conducted to measure then actual risk the firm is facing under 1 in a billion or 1 in 1 scenarios. Then the firm should evaluate the amount of risk faced with the amount of risk it can take. Third, proper regulation should be carried out. High standard of regulation regarding the limits of amount of risk to be taken and the total expected shortfall should be set in place. 4. Limit on extension on trading credit. A company should not be over-leveraged. During the crisis, its leverage ratio was as high as 250 to 1. The amount of risk a firm can take along with the domino effect on parties involved should be taken into account before trading credit is extended.